Good morning. Welcome to another Tax Associates Tax Tips. Today we're going to see 5 ways to withdraw cash from your corporation while avoiding dividend treatment. Do you want to withdraw cash from your closely held corporation at a low tax cost? The easiest way is to distribute cash as a dividend. However, a dividend distribution isn't tax efficient, since it's taxable to you to the extent of your corporation's earnings and profits, but it's not deductible by the corporation. Different approaches. Fortunately, there are several alternative methods that may allow you to withdraw cash from the corporation while avoiding dividend treatment. Here are 5 different ideas. First, capital repayments. To the extent that you have capitalized the corporation with debt, including amounts that you have advanced to the business, the corporation can repay the debt without the repayment being treated as a dividend. Additionally, interest paid on the debt can be deducted by the corporation. This assumes that the debt has been properly documented, with terms that characterize the debt and that the corporation doesn't have an excessively high debt to equity ratio. If not, the debt repayment may be taxed as a dividend. If you make cash contributions to the corporation in the future, consider structuring them as debt to facilitate later to withdrawals on a tax advantage basis. Second, salary. Reasonable compensation that you or your family members receive for the service rendered to the corporation is deductible by the business. However, it's also taxable to the recipient. The same rule applies to any compensation in the form of rent that you receive from the corporation for the use of property. In either case, the amount of compensation must be reasonable in relation to the services rendered or the value of the property provided. If it's excessive, the excess will be non-deductible and treated as a corporation distribution. Third, loans. You might withdraw cash from your corporation tax-free by borrowing money from it. However, to avoid having the loan characterized as a corporate distribution, it should be properly documented in a loan agreement or a note and be made on terms that are comparable to those on which an unrelated third party would lend the money to you. This should include a provision for interest and principal. All interest and principal payments should be made when required under the loan terms. Also, consider the effect of the corporation's receipt of interest income. 4. Fringe benefits. Consider obtaining the equivalent of cash withdrawal in fringe benefits that are deductible by the corporation and not taxable to you. Examples are life insurance, certain medical benefits, disability insurance, and dependent care. Most of these benefits are tax-free only if provided on a non-discriminatory basis to other employees of the corporation. You can establish a salary reduction plan that allows you and other employees to take a portion of your compensation as non-taxable benefits rather than as taxable compensation. 5. Property sales. You can withdraw cash from the corporation by selling property to it. However, certain sales should be avoided. For example, you shouldn't sell property to a more than 50% owned corporation at a loss, since the loss will be disallowed. And you shouldn't sell depreciable property to a more than 50% owned corporation at a gain, since the gain will be treated as an ordinary income rather than capital gain. A sale should be on terms that are comparable to those on which unrelated third party would purchase the property. You may need to obtain an independent appraisal to establish the property's value. If you're interested in discussing any of these ideas, contact us. We can help you to get the maximum out of your corporation at the minimum tax cost. Don't forget to subscribe and call us if you have any additional questions. Thank you.